Steven Haber de la Universidad de Stanford. Voy a hacer la entrevista en inglés porque el profesor Haber pues ese es su primer idioma. Thank you for your time and welcome to Colombia.
Thank you very much. I'm delighted to be here.
Okay, so let's start from the main topic that you came here to analyze in this conference here in Medellin. Basically, it's the connection between political institutions and the development of financial markets and banking sector. Can you give us a little bit of overview of your research and your main views on this topic?
I'd be delighted to. I think the thrust of my research, which encompasses work beginning with some co-authors, Noel Maurer and Armando Raso, going through some work with Douglas North and Barry Weingast, and now most recently in a book forthcoming with Charlie Calamiris, is about the notion that it is very hard to get politics out of finance, particularly hard to get politics out of banking. And it's hard to take the politics out of banking, or express it somewhat differently. Countries get the banking systems and the financial systems that their political institutions will permit. They don't choose their financial systems or their banking systems in any common sense use of the word choose. Rather, the way to think about the allocation of credit, the allocation of losses when banks fail, and the rules governing entry and regulation, these are all outcomes of a political bargain made between governments and bankers, and also involved other politically crucial groups in society. And so to think that countries in some sense are choosing to have narrow credit or an unstable financial system misses the point. Unstable credit and narrow financial systems are outcomes of a country's politics.
So now that we're going through a lot of financial crisis, or one main financial crisis, let's divide it into two parts. First, the developed world. The US in 2008, 2009, and more recently Europe with its different financial crises. One main source of the problem has been politically. There seems to be a consensus that politics have been very dysfunctional both in the US and in Europe. So what's your view with regards to your research on the evolution of current financial crisis in the developed world, and how is that going to develop in the future? Because it doesn't seem that politically speaking things are going to get good in the near future.
So one thing I would stress is that the financial crises of the United States and of Europe are somewhat different animals. And so let me take them separately. The financial crisis in the US, and this is something that Charles Calamiris and I talk about in our forthcoming book, Fragile by Design, was an outcome. So all banking crises require two features in order to unfold. One is you need imprudent lending by banks, and the other is you need inadequate capital backing those loans. If you don't have both ingredients, you can't get a systemic banking crisis. The politics of the United States in the 1990s were such that the government, the Clinton government in particular, wanted to redistribute income, but it couldn't do it through the fiscal system. So it decided to do it through the banking system. That goal was consistent also with a goal of activist groups in the United States to direct credit to their constituents from banks. The lever that both the Clinton administration and the activist groups had was the desire of big banks to merge, because we had had a period in which we blocked bank mergers for most of US history. In order for excuse me, in order for banks to merge, they had to be approved by, the merger had to be approved by the Federal Reserve, the Board of Governors of the Federal Reserve. And that created an opportunity for activist groups to form coalitions with banks in which the activists would support bank mergers or block bank mergers. There were arrangements made between banks and activist groups to allow the activist groups to allocate credit or to direct credit to their constituents. This required that the banks have the ability to then sell those loans that they had made via these deals with activist groups to Fannie Mae and Freddie Mac, government-chartered private enterprises, but with very special charters. That meant that it was possible, both for the Clinton administration, for its own reasons, for the activist groups and the banks, to put pressure on the government to make Fannie and Freddie change their underwriting standards. Once they changed their underwriting standards to accommodate these special interests, they had to change their underwriting standards for everyone. And so the United States moved very quickly from a system in which to buy a house you had to have a stable income and that you could document and a 20% down payment to a system in which you didn't have to document your income and in which down payments were as little as 3% and sometimes 0. The only way that Fannie and Freddie would go along with this was if they could hold lower levels of capital than private banks. That set off through the process of securitization, the agreement to let Fannie and Freddie hold lower levels of capital through the process of securitization set off a minimization or a fall in the amount of capital backing all of these mortgage loans. And so the U.S. had a banking crisis, the size of which hasn't been, we hadn't had since the 1930s, that was fundamentally based in housing, and it was fundamentally driven by a well-meaning, if somewhat misguided, attempt to redistribute income through the banking system. The European banking crisis is a somewhat different animal. A lot of it has to do with not lending for home ownership, although there's some of that in Southern Europe. A lot of it has to do with sovereign debt. And the basic problem in Europe was that the political goal of the EU was to create a single currency and a single economy, not to solve an economic problem, but to solve the problem of endemic war in Europe. European history is, if you compare it, let's say, with the history of Latin America, what's interesting about European history, and also tragic, is the long periods of time, and we're basically talking from roughly the late 1690s up until 1945. With a few brief exceptions, Europe's at war. There's a period in roughly from 1850 to 1870 where they're not killing each other. But except for that period, Europe is at war. And so the EU was an attempt, or is an attempt, to end endemic violence. Creating a single currency zone was an outcome of that goal, but there was a fundamental flaw, which many people, including my co-author Calamiris, pointed out back when the euro was created, which was that you had some economies with very fast productivity growth, like Germany, and some economies with very slow productivity growth, like Greece. If you can't adjust the exchange rate in order to accommodate the fact that productivity is growing faster in one place than another, it implies that what you're going to have is very low levels of employment in the slower growing productivity economies. The European countries wanted to avoid that, and so what they basically did was they allowed Southern Europe to borrow from Northern Europe. The net result was that you got mushrooming levels of sovereign debt in Southern Europe. there comes a point for any country where the creditors realize that the level of sovereign debt has outstripped the probable ability to repay. And so what has occurred in Europe is a crisis not so much driven by the political decision to redistribute income across social classes, but a political decision to create a single currency zone without many of the features that make single currency zones actually work elsewhere in the world. Let me give you an example. The United States has a single currency zone, right? We all have the dollar. There's vast differences in the productivity, let's say, between the economy of California and the economy of Mississippi. The economy of Mississippi can't devalue its currency because we're all in the same currency. So to prevent everybody from leaving Mississippi, or to prevent the Mississippi economy from sort of falling through the floor because of the differences of productivity, we engage in massive transfers. Those transfers, some of them appear on the budget, but many of them take place, for example, through the defense budget. They take place through the Department of Education budget. And they take place through sort of various sort of federal arrangements, for example, disaster relief and the like, such that there's a transfer of capital, and of course there's complete mobility of labor across states. Europe's not like that. You don't have. When they created the Eurozone, they didn't create fiscal transfers from the high productivity countries to the low productivity countries. There aren't even disguised ways to do it. So you wound up with the need for countries to sort of perpetually borrow to sort of maintain standards of living of the population. And one of the things that fueled, all that borrowing, was, well, what are we going to do with, how are we going to maintain full employment? Well, let's build housing. So I think that's a lot of was under the Spanish housing boom, for example. Both are the short answer is both crises were politically driven, but with different political goals and with different political mechanisms.
So let's jump to the other side of the spectrum, which is the emerging economies, and more specifically Latin America, which is also an area you have studied extensively. It seems that Latin America, has gone through many financial crises as well, and it seems that so far we can kind of have learned a little bit from our mistakes, and some of the crises that have gone through in the U.S. and Europe recently, not necessarily the same, but Latin America has had a crisis because of sovereign debt, crisis because of housing bubbles, et cetera, et cetera. How do you see today's situation of the financial system in Latin America in general? Compare us the way it was before, because again, political institutions in Latin America, even though today they might be stronger than what they were 10 years ago, 20 years ago, there's still some issues out there. The rule of law is, it's under question in some countries. Democracies are not that stable. There's a lot of issues when it comes to the political organization and institutions that still have to be worked on in Latin America. So how do you see the situation of the financial system in Latin America, and how do you see it going forward, especially learning from the mistakes that the developed world has made recently?
That's a great question. So there are really two issues facing Latin America, and they both make me a little nervous about the stability of the banking system. The first is that throughout most of Latin American history, banking sectors tended to be quite small. They tended to be quite small because you didn't have democratic governments. And what banks really were in the business of doing was, A, lending to the government, in exchange for which governments restricted entry into banking to raise rates of return for bankers so that they would take out a charter in a situation in which the government wasn't democratic. That meant that banks tended not to develop systems of credit reporting, and societies tended not to develop institutions designed to enforce contracts between banks and debtors. a lot of bank lending really was between a few large firms and a few large banks. So Latin American countries in general didn't have this sort of endogenous process of institutional development in which things like efficient credit registries, honest police, efficient courts, efficient bankruptcy laws were developed that allow contracts to be enforced. So that's a big limitation on what banks can do, because without the ability to enforce contracts, banks have no incentive to lend, because the borrower has an incentive, if he knows the contract's hard to enforce, to not repay. At the same time, in the last 15 years, Latin America has gone through this rapid wave of democratization that, for someone who's been traveling to the region since I was 13 years old, has been really marvelous. The changes that have occurred in Latin America are amazing, considering the history, certainly from the 70s to the present. However, democracy comes at a cost to banking systems, which is that voters can vote for credit. That is, they can vote for candidates who promise to make banks lend, or who promise to lower interest rates. And so political pressure then gets put on banks. This is somewhat similar to what happened in the United States in the subprime crisis. Political pressure then gets put on banks to lend more and reduce interest rates. But without the institutions that you would actually need to enforce those contracts if they went into default. Bankers are not dumb. They can see they're in a vulnerable position. What is their best move? Their best move is to ask the government to create second-tier lenders that will repurchase a lot of these loans that they're going to be sort of encouraged or forced to make. These second-tier lenders are going to have some of the characteristics of Fannie Mae and Freddie Mac in the United States.
Would that be something similar to what BNDES is?
Yes.
Okay.
Yeah, exactly.
Okay.
Right. Now that creates a funny problem. In good times, when everything's functioning smoothly, the second-tier lender like BNDES in Brazil is simply buying up loans that are originated by private banks. What happens in a crisis when debtors now start to default, especially if they were able to purchase properties under, because for political reasons, under sort of easier and easier conditions? What means your government-run bank, like BNDES, is now full of toxic assets. How will you clean that up? Well, the rest, taxpayers, are going to bear the bill. One of the things I think is just really important for people to keep in mind is there are no free lunches. At the end of the day, somebody bears the cost of cleaning up a fragile banking system. And so with pressure to expand credit beyond the ability of the market-based institutions to actually enforce those contracts, what can happen is countries get set up to have a systemic banking crisis in which it's the government-owned banks that are sitting on top of the toxic assets. In this sense, it's somewhat similar to what happened in the US with Fannie and Freddie.
Are you concerned about the current policies of the main central banks in the world of providing very, I wouldn't say, well, yeah, I guess it's excessive, but it's a lot of monetary easing, the way the Fed is doing, the way the Central Bank of Japan is doing, because obviously that is creating potentially another bubble for the future for another financial crisis. I mean, that remains to be seen, but
Yes.
obviously there's a lot of criticism about what central banks have been doing. Obviously has a lot of effects, not only in their respective countries, but also in emerging economies like ours.
Mm-hmm.
There's been a lot of talk that because of those easy policies in the developed world, assets in emerging economies and Latin America, Colombia also as well, have gone through the roof, house prices, credit, et cetera, et cetera. So how concerned are you about the current situation of central banks in the world?
So I am concerned, and I'm concerned in the following sense. In a crisis, central banks respond to what is a very real threat of a systemic banking crisis, sort of causing an economy to fall in on itself. And one response is to ease liquidity. In the case of the Fed in the United States, to very actively buy up treasuries as well as mortgage-backed securities. And that in the United States has sustained something of a modest recovery. This is well-meaning. It's not irrational. The problem is that at some point, the expansion of the money supply that is necessary to carry this off will result in inflation. Central bankers know this, and they always seem to believe that they can time things just right so that they'll start to increase interest rates and restrict liquidity just as inflation starts to rear its head. That's actually an extremely hard thing to do. Usually they're going to be trailing the markets. So one outcome that I do worry about is not only a sort of a second housing bubble, but also a period of rampant inflation.
Let me ask you a last question, which I always ask all our guests. This financial crisis of 2008-2009 has been probably extraordinary compared to other financial crises. Although some things are similar, but in general, this is a special financial crisis. And it seems that a lot of very well-renowned economists around the world have come up saying, you know, I thought my views were in that direction, and because of this financial crisis, maybe some of the things that I thought before were not right. More specifically, Alan Greenspan, in a testimony, came up and he basically said, you know, I thought something and I think I was wrong. What would you say is the thing that you've learned the most from this financial crisis that maybe you didn't really have in your radar before this crisis, and that maybe have changed a little bit the way you see financial crisis and banking systems, capital markets, et cetera, et cetera?
Well, I would go back to where we started, which Charles Calomiris and I started our book, Fragile by Design, in the midst of the 2008 financial crisis. We were motivated in large part to do this study of why it's so hard to create stable and efficient banking systems by the fact that the banking systems around the world, especially in the developed economies, were in serious trouble. One of the things that we learned as we wrote the book, and we learned as sort of the crisis unfolded, one of the things that was really driven home to us again and again was the idea that the origins of the crisis weren't that central bankers didn't see what was coming and tried their best, but they're not omnipotent. One of the things that impressed us when you look at the evidence is how clear it was to people on the inside how fragile the banking system in the U.S. was becoming. But the sort of political mandates or the political pressure to not change course was so strong that everybody sort of crossed their fingers and hoped for the best, which is maybe fine in some things in life, but certainly not in the management of a banking system. So I think that the thing that really was driven home to me in a way that I had never fully appreciated, I'd always thought it but never fully grasped its impact, is the notion that there is no getting politics out of bank regulation or bank supervision. There is no getting politics out of financial policies. That though, if societies want to avoid having unstable financial systems, what they need to think about are the basic political institutions that structure the coalitions that give rise to the particular sets of regulations that bring you crisis. The sort of notion that many people have, which is crises just sort of occur randomly around the world, and then central banks sort of try to do the best they can, simply doesn't stand up to the evidence.
Okay, many thanks for your time.
It was a pleasure.
It was a pleasure.